So my research focuses on the interaction among firm disclosure behavior, insider trading, and litigation outcomes. And I examine what are the kind of settings that lead managers to provide forecasts with their quarterly earnings release, or whether they decide to withhold those forecasts, and whether incentives play a role, such as insider trading, or whether the desire to reduce the likelihood of litigation plays a role in that. So what are the determinants of whether management decides to go above and beyond providing the normal required accounting disclosures every quarter, and in addition provide more qualitative or more subjective forecasts of the company's future prospects? So in a recent study of mine, my co-author and I examined a sample of firms which announced disappointing quarterly earnings, and whether or not firm managers gave any warning about it prior to the announcement. And we find that when company managers sell more of their own shares in the firm after the prior quarter's earnings announcement, they're much less likely to warn about the current quarter's earnings disappointment so as not to dampen the share price when they sell. We call this behavior strategic silence. And what's more interesting is when we bring litigation into the story. We find that the likelihood the firm will get sued after the earnings disappointment is related to both strategic silence and insider selling, and that there's an interactive effect between the two, meaning that silence and selling enhance the effect of each other in predicting litigation. So the main takeaway for managers who are aware of an upcoming earnings disappointment is that warning ahead of time can save a lot of headaches down the road in terms of litigation, and especially so if they're planning to divest or sell off some of their own holdings in the firm after the earnings announcement, because this is a key behavior that potential plaintiffs look for when deciding whether or not to initiate class action litigation against the firm. So we're now looking at what happens to the firm's disclosure and trading behavior after the firm gets sued. We know from our prior study that silence and insider selling both affect the likelihood of the firm getting sued. But what happens to that behavior after the lawsuit? Does the lawsuit instigate changes in whether or not managers are much more likely to warn of an earnings shortfall after they get sued? And also, are firms much more likely to have their managers engaging in selling prior to an earnings shortfall? Does a lawsuit actually instigate changes in behavior in these dimensions?